Welcome to the Deep Dive. Today we're jumping right into Advance Auto Parts' latest quarterly results and, importantly, what they're telling us about the rest of the year. It's not just numbers, it's about seeing how their big strategic changes are playing out. Advance Auto Parts, huge player, pros, DIIers, just dropped their Q2 2025 results.
And right away, there's this interesting little puzzle. They actually beat the earnings forecast, but then the stock dipped pre-market. So yeah, our job today is figure out why, look at their updated guidance, and really see what this means for where they're headed. It's a fascinating look at strategy versus market reaction.
Yeah, that pre-market dip definitely caught my eye.
Yeah.
So let's kick off with the headline numbers, because like you said, it seems confusing at first. Advance Auto Parts Q2 adjusted diluted EPS, that's earnings per share, it hit 0.69 cents. That's way above the $1.53 forecast. A 30.19% beat. And revenue was slightly ahead, too, at $2 billion. So seems good, right? But then the market reacts. Pre-market, the stock drops 7.77%, down to $57.01. Okay, let's unpack this. How does a beat like that lead to a drop? What's going on?
Well, that's exactly it. The market's looking deeper than just that EPS number. A big piece here is the 8% drop in net sales compared to last year. That tells investors, okay, they hit the earnings target, maybe through cutting costs or, something specific to the quarter. But the core business, the actual sales coming in, is still shrinking. It points to worries about the wider market, especially that DIY segment they serve. It really shows how, just hitting a number isn't the whole story. It's how you hit it and what the bigger picture looks like long term.
Right, context matters. So despite that stock reaction, the CEO, Shane O'Kelly, still called them solid second quarter results and pointed to getting back to profitability. So if we dig past those headlines and the market's initial take, what does solid actually look like in the Q2 details?
Yeah, solid might be fair in some ways. Looking closer at Q2, net sales were $2.0 billion. And like we said, that is down 8% from $2.2 billion last year. But there was a small positive. Comparable store sales actually edged up by 0.1%.
Okay, tiny bit of growth there.
Tiny bit, yeah. Driven mostly by their professional side, the pro business. And importantly, they mentioned seeing early signs of stabilization in the DIY business, which has been struggling. Now, profitability. Adjusted gross profit came in at $0.9 billion. That's 43.8% of net sales.
Pretty strong margin.
It is, yeah, a definite margin expansion. They said it was mostly savings from optimizing their store footprint back in March. Now, there was an offset, something technical called a reversal of previously capitalized inventory costs. Basically, an accounting adjustment hitting this quarter. SG&A expenses, selling, general and admin, were $819 million, or 40.7% of net sales. That was flat compared to last year, mainly because they have fewer stores now. All that led to an adjusted operating income of $61 million, or 3.0% of net sales. That's about 20 basis points of margin expansion. Small, but positive.
Okay, so some positive signs on margins despite the sales dip. What about cash flow?
Cash flow is still a challenge. Free cash flow was negative $201 million through Q2. That's quite a bit more outflow than the negative $48 million they saw in the same period last year.
Okay, so still burning cash then. But despite that outflow, they still declared a dividend. $0.25 per share, payable in October.
They did, and that sends a signal, right? Even with negative cash flow and this big turnaround effort, paying that dividend says we're committed to shareholders for the long haul.
Right. A sign of confidence, maybe.
Absolutely. And that fits with the bigger strategic moves they're making. Just recently, they did a major reorganization of their debt. They issued $1.95 billion in senior notes and set up a new $1.0 billion asset-backed revolving credit line, replacing their old one.
Okay, why the big debt shuffle now?
Well, their explanation is that it's proactive. They need the financial flexibility, it helps support their supply chain financing, and crucially, they called it a bridge structure. A bridge to what? To getting back an investment-grade credit rating down the road. So it's about strengthening the balance sheet now to improve their standing later.
Got it. So financial maneuvering to support the actual business changes. And those changes fall under their three main strategic pillars, right? Merchandising, supply chain, and store ops.
Exactly. Those are the buckets for all the operational work. And they're reporting some, real progress. Take merchandising. Big focus on cutting product cost. They're aiming for 50 basis points of annualized cost reduction this year, and they're adding products like crazy. Over 60,000 new SKUs so far this year. That's almost a 300% jump from last year.
Wow, 60,000. That's massive.
It is. And they're rolling out a new way of organizing products, an assortment framework in their top markets. It's in the top 30 DMAs now, aiming for the top 50 by end of Q3. And the early results are good. They're seeing about a 50 basis point lift in comparable sales where they've implemented it, 0.5% increase.
Okay, tangible results there. What about the supply chain?
Supply chain is seeing big changes too. They're closing distribution centers, consolidating, expecting to go from 28 down to 16 by the end of this year. It's about efficiency. They're seeing DC productivity improve, things like a 33% drop in shipment errors to stores in the last 6 months. That's significant.
Definitely reduces headaches for the stores.
For sure. And they're expanding these market hubs, planning 10 new ones this year, aiming for 60 by mid-2027. And those hubs, they're seeing an average 100 basis points comp sales lift, a full percentage point.
Interesting. So those hubs are working well. And the stores themselves, store operations.
Yeah, store operations. The pro business keeps growing positive low single-digit comps, and they've sped things up for those pro customers. Time to serve is now in their 30-40 minute target range. Last year it was over 50 minutes.
Big improvement for busy mechanics.
Exactly. On the DIY side, it's still about those signs of stabilization. But they are spending money on the stores. A lot more, actually. They said they've invested 3 times more in maintenance CapEx just this year to date than in all of 2024, fixing up over 1,000 stores, HVAC, roofs, paint, signs, trying to make them better places to shop.
Okay, so serious investment going into the physical stores, the supply network, and the products. There's a lot of moving parts. So it's all that going on. What does this mean for the rest of 2025? What's the updated guidance look like?
Well, surprisingly perhaps, most of the full-year guidance is actually unchanged. They reaffirmed it. They're still expecting net sales between $8.4 and $8.6 billion. Still looking for comparable store sales growth of 0.5% to 1.5%. Adjusted operating income margin target is still 2.00% to 3.0%. Capital spending around $300 million.
And the free cash flow, still negative.
Still negative, yeah. The expected outflow for the full year is still between $85 million and $25 million. And still planning 30 new stores, 10 new market hubs.
Yeah. What did change then?
The only thing they revised downwards was the adjusted diluted EPS guidance for the full year. It's now $1.20 to $2.20. It was $1.50 before. And the reason, pretty simple. Higher net interest expense because of that big senior notes offering they just did.
Ah, okay. So the debt restructuring, while strategically sound perhaps, hits the bottom line this year through higher interest costs. Makes sense.
Yeah.
But they're still projecting positive comp growth, low single digits in Q3 and Q4. Given the sales decline in Q2, where's that confidence coming from?
It seems to be a couple of things. One is just easier comparisons to last year. They mentioned things like the CrowdStrike incident. Remember that big IT outage?
Right, that hit a lot of retailers.
Yeah, and they also had significant hurricane impacts last year that depressed sales. So the bar is lower, basically. They also said they saw improving trends late in Q2 that carried into Q3. And then there's tariffs.
Tariffs.
Always a factor.
Always. About 40% of their cost of goods are exposed, they said, at a blended rate around 30%. They expect this to cause low to mid-single-digit inflation on the same items in the second half. They sounded pretty cautious about passing that all on, especially to the DIY customer, worried about elasticity, particularly for lower and middle-income folks already squeezed by car insurance hikes and food prices.
Yeah, that DIY customer is definitely feeling pressure. Okay, so looking even further out, they have these 2027 goals, right? Like $9 billion in sales, continued growth, and a much healthier operating margin, around 7%. That's the target. Along with getting their debt down relative to earnings, that net leverage ratio target of around 2.0 to 2.5 times, specifically aiming to win back that investment grade rating.
It sounds ambitious. Is it a straight shot from here to there?
Oh, definitely not. And they acknowledged that. They basically said, look, 2025 and 2026 are heavy lifting years, implementation years. Things like vendor talks, how customers react, it's all dynamic. Progress won't be linear. It raises that key question, right? How smooth can this journey really be when so much is changing internally and externally?
Yeah, good point. And you mentioned the gross margin earlier, how those inventory costs played a role. It feels like they're constantly balancing cutting internal costs against these external pressures like tariffs. How are they managing that specifically for gross margins?
It sounds like a careful balancing act. On pricing related to tariffs, they're being rational, as they put it, watching competitors, watching how demand reacts, trying to hold prices where they can, but really focusing on growing the total profit dollars, not just the margin percentage sometimes. And they keep pushing initiatives to help the DIY side training, free services like battery tests, check engine light scans, while also really doubling down on the pro side, especially those Main Street pro accounts, the local garages, building loyalty across the board.
So wrapping this up, it seems Advance Auto Parts is deep in the trenches of a major turnaround. We're seeing real progress on their key strategies, merchandising, supply chain, stores, but they're doing it against a tricky economic backdrop, managing this big debt restructuring and trying to balance today's results with that longer-term vision.
The market maybe reacted nervously short term, but the company seems focused on the plan.
Exactly. It's complex, which leaves us with something for you, the listener, to think about. What really stands out to you when you see a company trying to juggle immediate financial pressures with a long-term transformation like this? Especially when the market doesn't always seem convinced right away. And maybe closer to home, how do you think these kinds of big internal shifts at a company like Advance Auto Parts might eventually trickle down to affect, say, the cost or the speed of your next car repair or your next DIY project?